Okay, good morning, friends. Just welcome back to the discussion on basic concepts. So let's move on to the rest of the syllabus which is left over. Let's look into that, Kanna. The rates of income tax which are applicable. So basically, what are the rates of tax which are applicable? General rate as well as the specific rates. First, look into the general rate of tax which were brought in by Finance Act 2020. These are the tax rates which are applicable for the previous year 2021 or the assessment year 21-22 for the different categories of SCs. Now look at first one, they're talking about the tax rates which are applicable to ordinary individual and the Hindu undivided family. First one they're talking about, sir, for individual, for the Finance Act 2020, they given two slabs. One is normal rates of tax which are applicable. Second one, in case if the individual or HUF opted for concessional rates of tax. Right, under section 115 BAC. Okay, two ways they're talking about. When he is not opting for 115 BAC and when he is opting for 115 BAC. Now, in case if the SC is not opted for section 115 BAC, that is what concessional rates of tax. Then what are the normal rates of tax applicable to the individuals? Now look at in case if the SC is an individual that is other than senior citizen, any individual whose age is below 60 years, or Hindu undivided family, even for HUF. Okay, in case if the individual is not a senior citizen, then the normal rates of tax which are applicable, sir, income up to 2,50,000, first 2,50,000 is going to be basic exemption, so applicable tax rate will be nil. And income excess of 2,50,000 and up to 5 lakh. Okay, the 2 lakh to 2 lakh 50 to 5 lakh, the differential 2 lakh 50,000 is going to be taxable at the rate of 5%. And above 5 lakh rupees and up to 10 lakh rupees, the differential 5 lakh is going to be taxable at the rate of 20%. And in case the total income of the SC is over and above 10 lakh rupees, and that excess is going to be taxable at the rate of 30%. So these are the income tax slabs that are applicable for ordinary individual other than the senior citizen. And next one, for Hindu undivided family, up to 2,50,000 is a basic exemption. 2,50,000 to 5 lakh is going to 5%. 5 lakh to 10 lakh is 20%. About 10 lakh is 30%. This is general income, Kanna. in case if the SSC is a resident individual and who is a senior citizen. What do you mean by senior citizen? At any point of time during the relevant previous year, in case he attained the age of 60 years or more but less than 80 years, then they are giving a slightly higher basic exemption. Up to 3 lakh rupees is going to be basic exemption. Remaining slabs are going to remain the same. Up to 3 lakh is a basic exemption. 3 lakh to 5 lakh is 5%. 5 lakh to 10 lakh is 20%. About 10 lakh is going to be 30%. Compared to ordinary individual, in case if the SC is a senior citizen, they are giving a slightly higher basic exemption, that is 3 lakh rupees. And in case if the SSC attained the age of 80 years or more at any point of time during the relevant previous year, any SSC who attained the age of 80 years or more. Okay, 80 years or more means very senior citizen, Kanna. For very senior citizen, the rates of tax what they are talking about. So slightly higher basic exemption. Up to 5 lakh rupees is going to be basic exemption, and 5 lakh to 10 lakh will be straight away at 20%. About 10 lakh is 30%. Can you look at the normal tax? These tax rates are applicable if the individual is not up to be taxed under section 115 BAC. Concessional tax system is not opting for normal tax ratio. In case if you are an ordinary individual, not a senior citizen, age is below 60 years, then up to 2,50,000 is a basic exemption. 2,50,000 to 5 lakh is 5%. 5 lakh to 10 lakh is 20%. About 10 lakh is 30%. In case this is senior citizen, basic exemption will be 3 lakh. 3 lakh to 5 lakh is taxable at 5%. 5 lakh to 10 lakh is 20%. About 10 lakh is 30%. In case is a very senior citizen, there is 80 years or more, up to 5 lakh is a basic exemption. 5 lakh to 10 lakh is 20%. About 10 lakh is 30%. In case if the individual, irrespective of the age, whether you are an ordinary individual, senior citizen or very senior citizen, or HUF who opted to be taxed under concessional tax regime, there is 115 BAC. Under 115 BAC, SSC is not permitted to avail certain deductions, certain exemptions. In case if you are not availing certain deductions or exemption, then the total income is going to be taxable at a comparatively concessional rates of tax. So here you need to understand one thing, friend. Every time your total income is getting increased by 2,50,000. Slab what they given, every time your income is getting increased by 2,50,000 and the tax rate is getting increased by 5%. So in case if the SC opted for 115 BAC, then 2,50,000 is the basic exemption, remain the same, and 2,50,000 to 5 lakh, the differential 2,50,000 is going to be taxable at the rate of 5%, and 5 lakh rupees to 7,50,000, there is a next 2,50,000 income is going to be taxable at the rate of 10%. Next one 7,50,000 to 10 lakh, next 2,50,000 is taxable at the rate of 15%, and again 10 lakh rupees to 12,50,000 is going to be taxable at the rate of 20%, and 12,50,000 to 15 lakh, next 2,50,000 is taxable at the rate of 25%, and above 15 lakh rupees, okay, the total income is going to be taxable at the rate of 30%. These rates are applicable when in case if the individual or HUF is up to be taxed under section 115 BAC, concessional tax system. Every time income is getting increased by 2,50,000 and your tax rate is getting increased by 5%. Up to 2,50,000 basic exemption, 2.5 to 5 lakh is going to be 5%, 5 lakh to 7.5 lakh is going to be 10%, 7.5 to 10 lakh is going to be 15%, and 10 lakh to 12.5 is 20%, and 12 lakh to 15 lakh is going to be 25%, and above 15 lakh is going to be 30%. And there is going to be normal rates of tax and concessional rates of tax that are applicable to individual and HUF. Now, sir, what is the applicability of surcharge? Surcharge tax, the above tax rate generally what we got is going to be applied on the total income, general income. And again, surcharge is going to be levied on tax on total income. What is the total income? By using above rate, calculate what is the tax liability. On that, we need to apply this particular surcharge. Can I carefully understand? This surcharge is applicable to individual as well as HUF. Here they are talking about, sir, if total income is exceeding, remaining breakup, keep it aside. I'll pick it up in the assessment of individuals and HUF. Now, if total income of the individual or HUF is exceeding 50 lakh rupee but not exceeding 1 crore. In case if total income is exceeding 50 lakh but not exceeding 1 crore, surcharge is going to be 10%. And if it is exceeding 1 crore but not exceeding 2 crore, if total income is exceeding 1 crore but not exceeding 2 crore, surcharge rate applicable is 15%. Sir, my total income is exceeding 2 crore but not exceeding 5 crore. Surcharge rate applicable, how much they are talking about? 25%. Sir, if my total income is exceeding 5 crore, what is the surcharge rate they are talking about? 37%. Very simple to remember, Kanna. So even if it is exceed total income of the individual and HUF exceeding 50 lakh but not exceeding 1 crore, surcharge rate applicable 10%. Exceeding 1 crore but not exceeding 2 crore, surcharge is 15%. Exceeding 2 crore but not exceeding 5 crore, surcharge rate is 25%. Exceeding 5 crore, surcharge is 37%. Sir, what is that 111 capital A and 112 capital A? We will see later. Next one, sir, when what is the tax on total income plus where and all applicable depending on the total income, we need to add the surcharge at the applicable rate. This surcharge rate you need to apply on tax on total income. Now on the total of it, what is the tax on total income plus surcharge both put together? On that, okay, health and education cess HEC we are going to levy at the rate of 4%. Again, they are talking about the rebate under 87 capital A. Sir, in case if the SSE is a resident individual, for claiming this rebate, you should be individual, the two resident in India. Only resident individual can claim rebate under 87 capital A. And your total income criteria should not exceed 5 lakh. Sir, even the total income during the previous year should not exceed 5 lakh rupees. If the SC is a resident individual and your total income is not exceeding 5 lakh rupees, if when the above two conditions are getting satisfied, then rebate under 87 capital A what you can claim is 100% of tax payable on total income or 12,500 rupees, whichever is lower. So when first of all for claiming rebate under 87 capital A, you should be a resident individual. You should be individual resident in India during the previous year and your total income should not exceed 5 lakh rupees. If both the conditions are satisfied, what is the tax on total income? Or 12,500 rupees, whichever is lower, you are entitled to claim as rebate under 87 capital A. In addition to the above item, certain special incomes are going to be taxable at the special rate. These tax rates were covered under the Indian Income Tax Act 1961 itself. Sir, any kind of long-term capital gain is going to be taxable at what rate? 20%. Other than section 112 capital A. In case if that long-term capital gain you are getting on transfer of long-term listed security subject to payment of STT, that's covered in section 112 capital A. If that long-term capital gain on transfer of long-term listed security, if it is exceeding 1 lakh, the excess is going to be taxable at the rate of 10%. Correct, Amma? That is covered under 112 capital A. Except that all other long-term capital gains are going to be taxable at the rate of 20%. Again, short-term capital gain covered under section 111 capital A. So I am selling a listed security and on transfer of which is going to be subject to payment of security transaction tax STT. Then the resulting short-term capital gain is going to be taxable in the hands of the SC at the rate of 15%. Any short-term capital gain on transfer of a short-term listed security, the resulting short-term capital gain is going to be taxable at the rate of 15%. And casual income, there is a winning from lottery, crossword puzzles, races, including betting or gambling in nature. So entire this casual income straight away taxable at the rate of 30%. Kanna these rates should be on fingertips kanna. So long term capital gain covered under section 112 capital A is going to be taxable at the rate of 10%. And other than that, under section 112, all the long term capital gain are going to be taxable at the rate of 20%. Short term capital gain covered under section 111 capital A is taxable at the rate of 15%. And all other short term capital gain is going to be normal rate of tax applicable to the SC. And winning from lottery, there is nothing but 115 BB. Winning from lottery, crossword puzzles, races, including horse races, it is going to be taxable at the rate of 30%. First, the total income of the individual or HUF, we need to classify into two parts. Okay, what is the normal, the special income which is chargeable at the special rate, and ordinary income which is chargeable at the normal rate of tax applicable to the SC. For special income, we need to consider the special rates what I covered here. And again, for normal rates, you need to go with the slab-wise income tax rates what I covered. Then you will get a tax on total income. Then surcharge, and then health and education says here and there rebate also we are going to avail. Next one, they are talking about AOP or BOI, and next one AJP. Generally for AOP or BOI or AJP, generally the tax rate applicable is going to be the tax rate applicable to the ordinary individual up to 2,15,000, and 2,50,000 to 5 lakh is going to be 5%, 5 lakh to 10 lakh will be 20%, above 10 lakh will be 30%. And surcharge and health and education says same applicable to individual. That means already surcharge we card exceeding 50 lakh but not exceeding 1 crore, exceeding 1 crore but not exceeding 2 crore. Same surcharge, health and education says is going to 4%. Now when you look at cooperative society, Sir, Finance Act 2020 for cooperative society also they given two options karna. One is going to be normal rate of tax, and second one concessional rate of tax covered in section 115 capital BAD. So for availing this concessional tax rate in section 115 BAD, okay, the cooperative society is not eligible to claim certain deductions and exemption. If you satisfy the conditions covered in section 115 BAD 2, then you can opt for this concessional tax rate of 20%. Anyway, in case if you are not opting for concessional tax system under 115 BAD, normal tax rate that are applicable. First 10,000 income of cooperative society is taxable at 10%, and the next 10,000 income is taxable at 20%, and balance income over and above 20,000 taxable at the rate of 30%. Very simple. Okay, first 10,000 taxable at the rate of 10%, next 10,000 is taxable at the rate of 20%, and the balance is going to be taxable at the rate of 30%. And in case if you are opting for 115 BAD, there is a concessional tax rate system. Okay, subject to fulfillment of conditions what they call in section 115 BAD 2. Correct? Then the applicable tax rate is 22% including surcharge karna, including surcharge. So if you check out the breakup of this item, okay, concessional tax rate which is applicable under 115 BAD, applicable tax rate is 20%. Applicable tax rate is 20%. On the top of it, mandatory surcharge, irrespective of your total income of the cooperative society, will be 10%. So even if you calculate, if total income, if you are assuming 100 and the 20% tax rate, so you will get 20 rupee tax liability. On the tax liability, 10% is going to be surcharge. 20 into 10% 2. So even 20 plus 2, you are getting 22%. Correct? So when you look at 115 BAD, applicable entire income is going to be taxed in your hand at the rate of 20%, and mandatory surcharge of 10%. Okay, net to net you are getting 22%. Next one, normal, when the corporate society is covering under normal provision, if total income is exceeding 1 crore during the relevant previous year, normal provision karna, when you are not opting for 115 BAD, if total income exceeding 1 crore, then surcharge at the rate of 12%. If it's not exceeding 1 crore, no surcharge. On the total income, on the total tax liability, health and education cess will be 4%. So over the tax on total income plus surcharge put together, on that I need to apply 4%. Correct? Next one, the talking about the firms and LLP, partnership firm including limited liability partnership. The applicable tax rate is 30%, and surcharge of 12% if total income exceed 1 crore. If the total income of that firms or LLP during the relevant previous year, if it is exceeding 1 crore, then surcharge at the rate of 12% is applicable. On the top of it, health and education cess is 4%. And local authority, same thing kanna. So when for local authorities, okay, basically they're talking about applicable tax rate is 30%. If total income during the relevant previous year is exceeding 1 crore, surcharge at the rate of 12%, and the total tax liability 4% will be health and education cess. Next one, when you are looking at companies, Kanna, it is going to be slightly important item, Kanna, especially for finals. So obviously there is a company assessment. So these items are very, very important for the final, Kanna. At intermediate level, just if you know what the tax rate, that is sufficient. So in case domestic company, that is what our Indian company. Now, if they're talking about in way alternative mechanism they given up to be taxed under old regime, right Kanna? So if the turnover or the gross receipt of the previous year 2018-19 does not exceed 400 crores, Kanna check out 2018-19 Kanna. 2018-19, if the total turnover of the total domestic company is not exceeding 400 crores, then current year your total income taxable at the rate of 25%. And again, in case if you are a manufacturing company who opt to be taxed under section 115 capital BA, so it's a concessional tax rate system what they given. By satisfying the attached condition, you are prohibited on claiming certain deductions under 115 BA2. If you satisfy the conditions covered in section 115 BA2, that manufacturing company is liable to tax at the rate of 25%. If you are a domestic company and during the previous year 2018-19, your total turnover is not exceeding 400 crores, current year tax rate applicable is 25%. In case if you are a manufacturing company and you satisfied the conditions covered in section 115 BA2, then by virtue of section 115 capital BA, applicable tax rate for the current year is 25%. Other than these two, okay, generally a domestic company applicable tax rate is 30%. Right, Kanna? So even when you go with that exceptional concessional of 25%, remaining all other companies, general tax rate applicable to domestic company is 30%. And again, when you look at surcharge, sir, if total income of a domestic company not exceeding 1 crore, there is no surcharge. If it is exceeding 1 crore but not exceeding 10 crore, surcharge rate is 7%. If it is exceeding 10 crore, surcharge rate is going to be 12%. Correct? On the top of it, health and education cess will be 4%. Correct. General rate of tax applicable to domestic company, tax rate 30%. Surcharge if total income exceeding 1 crore but not exceeding 10 crore, 7%. Exceeding 10 crore, 12%. On the top of it, health and education cess will be 4%. And again, okay, concessional tax rate system. Sir, in case if the domestic company opting to be taxed under section 115 capital BAA, right, by satisfying attached conditions in section 115 capital BAA2. That means they said you cannot claim certain deductions, you cannot claim certain exemptions kind of it. Then by virtue of section 115 capital BAA, the applicable tax rate is 22%. What is the applicable tax rate that talking about, Kanna? 22. And the surcharge, okay, is going to be 10% because comparatively lower tax rate of 22% they given. So your total income is not a relevant criteria. Irrespective of your total income, applicable tax rate under 115 capital BAA for a domestic company 22%. On the top of it, mandatory surcharge of 10%. Again, health and education cess will be 4%. And because you are getting taxed at a concessional tax rate of 20%, surcharge is a mandatory surcharge. It's not depending on the total income. So accordingly, you cannot claim marginal relief. The concept of marginal relief is not applicable to you. And in case if it is a new manufacturing company and opt to be taxed under section 115 capital BAB, right, under section 115 capital BAB is a newly startup manufacturing company. So even in case if you satisfy under section 115 capital BAB2, they attach a certain condition. If all that conditions are getting satisfied, then applicable tax rate for the domestic company 15%, mandatory surcharge is 10%. Where and all I'm using a mandatory, your total income is not a relevant criteria. On the top of it, health and education cess will be 4%, and a margin relief is not available because there is a mandatory surcharge. And when you look at for foreign company, generally applicable tax rate is how much percentage, Kanna? 40%. Remember, Kanna? So generally for domestic company, tax rate will be lower. For surcharge will be lower for the foreign company. Applicable tax rate for a foreign company is 40%. And again, if total income of the foreign company during the previous year exceeding 1 crore but not exceeding 10 crore, applicable surcharge rate is 2%. If it is exceeding 10 crore, applicable surcharge rate, how much they are talking about? 5%. check out karna. Domestic company tax rate will be lower. For foreign company surcharge will be lower. For foreign company tax rate applicable 40%. Surcharge if total income exceeding 1 crore but not exceeding 10 crore 2%. If total income exceeding 10 crore surcharge rate applicable is 5%. On the top of it health and education says at the rate of 4%. Karna till now what we got is a general rate of tax. Now certain special rates were covered under Indian Income Tax Act itself. Under IT Act itself, certain special income are chargeable at the special rate. Sir, what are the special rates of tax applicable? Under section 111 capital A, this one already covered karna. Sir, if SC is transferring any short-term listed security, right karna, short-term listed security, be it equity shares of a listed company or units of equity oriented fund or unit of a business trust or units of fund set up under disinvestment of central public sector enterprises are subject to fulfillment of conditions, applicable tax rate is 15%. Simply remember karna 111 capital A. SC is transferring a short-term listed security and the transfer of which is subject to payment of security transaction tax. Then the resulting short-term capital gain and the transfer of that short-term listed security is going to be taxable in the hands of the SC at the rate of 15%. It is applicable for all SCs. Next one, section 112, that is long-term capital gain other than long-term capital gain covered in section 112 capital A. General long-term capital gains is taxable at what rate? 20%. And 112 capital A, sir, it is a long-term capital gain arising on transfer of a long-term listed security, be it equity share of a company or equity units of a equity oriented fund or units of a unit trust. Business trust. Basically I am transferring a long-term listed security and the transfer of which I am getting a long-term capital gain. Now check out what is the long-term capital gain. If the long-term capital gain is not exceeding 1 lakh, there is no tax. No, it's fully exempted. And in case if the long-term capital gain resulting is exceeding 1 lakh, the excess is going to be taxable at the rate of 10%. Let's say, sir, I transfer long-term listed security. I got 10 lakh rupees as short-term long-term capital gain. So the 10 lakh up to 1 lakh no tax. The balance 9 lakh is taxable at the rate of 10%. Next one, section 115 capital BB, casual income. So any kind of winning from lottery, crossword puzzles or including races, any races including horse races or any games which are involving gambling or betting in nature, everything is a painless money karna. Entire your casual income is going to be taxable at the rate of 30%. Entire your casual income is taxable at the rate of 30%. Next one, 115 BBC. Generally assessment of trust. For final this section number is very very important karna. Sir, anonymous donation received by any charitable or a religious institution. Any charitable trust or religious trust. Sir, what do you mean by anonymous donation? When you are collecting the donation, when you are receiving the donations, the donor complete particulars I need to maintain. What is their name, what is their address, what is their contact number, most importantly, what is their PAN number. If complete particulars you maintain, nothing is going to be taxable. You are collecting donation, but you are not maintaining the particulars of the donors. Then the donations in the hands of the recipient, we are going to call it as anonymous donation. The amount of anonymous donation received by a particular trust should not exceed 5% of your total donations what you received. If it is exceeding 5%, then that anonymous donation is going to be taxable at what rate? That about 60%. Anonymous donation, you are collecting donations, but you are not maintaining the particulars of donors. Then in your hand, that one we are going to call as anonymous donation. Anonymous donation is taxable at what rate? That about 60%. More about this 60%, we'll see in the assessment of charitable and religious trust, and basically as a part of your final. Next one, sir, 115 capital BBE. It's nothing but undisclosed income, unexplained income. Sir, basically any kind of undisclosed income which is covered under section 68 and 69. Be it undisclosed income, undisclosed property, undisclosed bullion, unexplained expenditure, all unexplained item. Sir, you had some income, you had some property, but you don't know what is the actual source of income for acquiring that property or incurring that expenditure. Any kind of unexplained investment, unexplained income or undisclosed income, undisclosed expenditure, everything is going to be taxable at the rate of 60% plus mandatory surcharge at the rate of 25%. 60% is the applicable tax rate for undisclosed income, plus 25% will be the surcharge rate that is applicable. More about this undisclosed I covered as a part of your business or profession karna, we'll see in the BP. And 115 capital B, income from life insurance business. In case you are engaged in the life insurance business and any kind of profit what you are making from life insurance, the entire profit is going to be taxable in your hand at the rate of 12.5%. Next one, section 115 capital BBD. Right करना, income of Indian company by way of dividend declared or distributed by specified foreign company. Kana, even more about it we'll see in assessment of company kana as a part of your final discussion. So in case if you are receiving a dividend from specified foreign company, not all kana, specified, that means you had an interest there. So in case if you are getting any dividend income from a specified foreign company, then the dividend income in your hand is going to be taxed at the rate of 15%. Next one, 115 capital BBF, there is nothing but income from royalty what you are getting, and there is going to be taxable in your hand. Royalty income studied by taxable at what rate kanna? 10%. Next one, 115 BBG, it is nothing but income from transfer of carbon credit. Kanna, when you are taking the activities to reduce the carbon dioxide in the environment, then obviously for a reduction in the carbon dioxide, okay, obviously they are going to issue carbon credit which are a tradable slip. So by transferring that carbon credit, any income you are getting, that carbon credit income is going to be taxable in your hand at the rate of 10%. Kana, these are the various tax rates that are applicable to different categories of the SSEs. Carefully check out kanna. Tax rate what we got, individuals and HUF, normal tax rates, individual, ordinary individual, senior citizen, very senior citizen, and concessional tax rates applicable to individuals and HUF under 115 BAC. Next one, applicability of surcharge, and next one, rebate under 87 capital E. Next one, special rates of tax, and again tax rate applicable to AOP or BO or AJP. And next one, applicable tax rate for cooperative society, normal rate and concessional tax rate under 115 BAD. Next one, firms and LLP, local authorities, companies, domestic as well as foreign, and special rates of tax which are covered under income tax, Income Tax Act. Is it clear kanna? And few more concepts when you check out. First one, they are talking about marginal relief. Kanna, carefully understand kanna. Sir, marginal relief can be claimed by any category of SC. It is not only for individual and HUF, it is applicable to all SCs. Sir, when your total income exceeding the threshold limit what they given for applicability of surcharge, marginally, by small amount, when your total income is exceeding the given threshold limit, because of that additional income, what the incremental tax liability you are getting, you are supposed to pay to the department, should not exceed the amount of additional income. Max of the max, how much more you end above the threshold limit, entire the additional income you can give to the department. But more than the additional income, department cannot ask you to pay the tax liability. So when your total income is exceeding marginally the given threshold limit for applicability of surcharge, then in case because of the additional income your incremental tax liability is higher than the additional income, then the incremental tax liability over and above the additional income can be claimed as a relief by the SSE, which is applicable to all categories of SC kanna. So I tabulated by stepwise calculation kanna, very simple item. Sir, margin relief is a reduction from the tax payable by the SSE. When you will get kanna, when your total income is exceeding the given threshold limit marginally, because of that if your incremental tax liability is greater than the additional income, that incremental tax liability over and above the additional income you can claim as a relief. And the relief from tax payable shall be given where the additional tax payable together with the surcharge exceed the income earned by the SSE in excess of the given threshold limit for applicability of surcharge. Right kanna? Sir, when your total income different threshold limit exceeding 50 lakh rupee, exceeding 1 crore, exceeding 2 crore, exceeding 5 crore. Sir, when your total income exceeding marginally the given threshold limit and additional tax liability on account of that is coming higher than the additional income, then what is the incremental tax liability minus additional income, the excess you can claim as a relief, which is known as margin relief. And the principle in margin relief is that additional amount of income tax payable along with the surcharge in excess of the given threshold limit should not be more than the amount in excess of the threshold limit. Max of the max, how much more income you got it, that income you can give to department, but department cannot ask you to pay more than your additional income. Is it clear kanna? Check out. Now competition procedure kanna, let's say I taken 50 lakh rupees or 1 crore, whatever it may be kanna, take one threshold limit. So first one, sir, my total income exceeding 50 lakh rupees marginally. When you are individual, total income exceeding 50 lakh rupee, then what is the surcharge rate applicable? 10%. Margin relief is nothing but, okay, tax on total income including surcharge less total income in excess of 50 lakh rupees plus tax on 50 lakh. Kind of simple item what they are talking about here. Check out kanna, any threshold limit common item. Step 1, I'm converting into stepwise procedure. So compute tax payable on total income. Compute tax payable on total income including surcharge. Including surcharge. Kana basically what is your actual total income? On that calculate what is the normal tax payable. Tax on total income plus surcharge put together. Step 2, calculate tax on the threshold limit. Let's say first time taking 50 lakh. Okay, in case if your total income is 50 lakh rupees only, then what the tax liability you are going to get? Plus total income in excess of 50 lakh. Up to 50 lakh threshold limit I am taking kanna, because your total income exceeding 50 lakh marginally. Step 1, what is your actual income? As per the regular procedures of IT Act, calculate what is the tax liability. Step 2, that incremental tax liability should not be more than your additional income. So when let's say my total income is only 50 lakh, on that calculate what is the tax liability. And for that, what is your total income in excess of 50 lakh? What is your total income in excess of that 50 lakh rupees? Calculate. The entire excess income I am giving to department. Max of the max, my maximum tax what I need to pay is going to be step 2 value, because you cannot ask me to pay more than that. Now step 3, okay, marginal relief is nothing but marginal relief is equal your step 1 minus step 2. Step 1 minus step 2. Simply kanna. So in case if a step 1 value is greater than step 2, because department cannot ask you to pay more than what you and over and above the given threshold limit. So up to 50 lakh I am paying a tax liability, plus what the total income I and over and above 50 lakh, entire thing I am giving to department. Max of the max, my tax liability is limited to step 2 value. So in case if the step 1 is greater than step 2, the excess you can claim as a marginal relief. Now what the net tax I need to pay? So net tax what I need to pay to department step 4 is nothing but tax on total income, that is step 1 minus margin relief as per step 3. So step 1 minus step 3 is nothing but net tax what you are supposed to pay to the department. Very simple item kanna. So when step 1, compute the tax payable on the total income including surcharge applicable. What is the actual income? On that calculate tax what you need to pay. Step 2, calculate tax up to the given threshold limit. So first I taken 50 lakh rupees threshold limit plus total income in excess of 50 lakh. Max, this is what the number what the department can ask me to pay. In case if your step 1 value is greater than step 2, step 1 minus step 2 I can avail as a marginal relief. After availing this relief, how much tax I need to pay? So your tax on total income minus relief under step 3 what you are getting, balance is nothing but a net tax what I am supposed to pay to the department. Correct, Amma? Which is exactly equivalent to your step 2. And even you can take 1 crore, 2 crore depending on the threshold limits. Next one, and this margin relief is important concept kanna, because we are going to work out few applications also. Next one, they are talking about diversion of income versus application of income. Kanna, diversion means from the source is getting applied kanna. Before the right to receive the income is getting established to the SSC, before I am getting a right to receive it, and before that income reaches to the SSC's hand, before the right to receive the income is getting established to you, or before the income reaches to your hand, by for discharging a super overriding title compared to what the right you had to receive the income, compared to that if a superior title, by discharging a superior obligation or overriding title, if some income is getting applied towards the discharge of that overriding title, that one we are going to consider diversion of income. Simple kanna. Before you are getting a right to receive the income, income is getting applied from the source where the income is getting earned, from the source something is getting applied for discharging what kanna, a superior title, a overriding title than what you had, and from source when the income is getting applied for discharging a overriding title or a superior title before the income is getting accrued to you or before the income reaches to your hand, and that application we are going to call as a diversion of income, because income is getting diverted from the source where the income is getting earned, and before the right to receive the income is getting established to you or before the income reaches to your hand. Correct, amma? Because it's getting applied, right to receive the income is not getting established to me, income is not reaches to SC hand, so that is not your income. Okay, that is not going to be considered, that is going to be allowed as a deduction, and that income, diversion of income what you made, that diversion of income is not your income, that is not taxable in your hand. And the application of income, kana application of income means, sir, right to receive the income got established to the SC, I'm entitled to receive the income, otherwise income already reaches to the SC's hand. Okay, after right to receive the income is getting established to you, or once the income reaches to your hand and you are applying that income for discharging a self-imposed obligation, so based on your morality ground, a self-imposed obligation on yourself, you are posing an obligation for discharging that self-imposed obligation. Okay, any part of that income which got accrued to you or which reaches to the SC's hand, if you are applying it, that one is known as application of income, because right to receive the income got established to you or the income reaches to your hand, so accordingly there is going to be taxable in your hand as a income, and that application of income cannot be allowed as a deduction. Next one, diversion of income means from source is getting applied for discharging of overriding title, so that is not your income, on that you are not required to pay tax. But application of income means right to receive the income reaches to the established to the SC, or income reaches to SC's hand for discharging a self-imposed obligation, you are applying that income, so accordingly that is your income only, because it is right to receive the income got established to you, accordingly that is not allowed as a deduction, that is going to be subject to taxation. Next one, method of accounting. Can I carefully understand karna? In the financial accounting we are going to talk about three different methods, but in direct taxation only two methods are going to be accepted. How many methods karna? Two methods. One is going to be cash basis of accounting, and second one is accrual basis of accounting. Accrual basis of accounting. Carefully understand karna. Under cash basis, sir, when to recognize the income? Okay, when to recognize the income? When you received cash against that income. Sir, when you received the cash against that income, then that income should be recognized in your books of account. Correct, Amma? And when you are talking about, sir, a particular expense should be recognized when you pay cash against that particular expense. Sir, as cash basis, income should be recognized in your books when you receive the cash against that income, and the expense should be recognized when you made a cash payment against that particular expense. Sir, under cash basis of accounting, what they are talking about, sir, income should be recognized when you are receiving a cash against that income, expense should be recognized when you made a cash payment. At that point of time, that particular income and expense should be recognized in your books of account. And when you are talking about accrual base of accounting, income should be recognized, any revenue or income should be recognized when it is earned. What do you mean by earned kanna? Right to receive the income. Right to receive the income. When right to receive the income is getting established, at that point of time that income should be recognized in your books of account. Sir, whether you actually received the cash against that income or not is immaterial. Income should be recognized when the right to receive the income is getting established. When you are getting a right to receive that income, immediately income should be recognized in your books of account. Whether you received the cash or not doesn't matter. At the same time, expense should be recognized. Expense should be recognized in your books of account when it is incurred. What do you mean by incurred kanna? The period when obligation to pay arises. Okay, when obligation to pay arises arise, at that point of time that expense should be recognized. As per accrual basis or mercantile basis, income should be recognized when it is earned, when the right to receive the income is getting established to you. Actual receipt of cash doesn't matter. And the expense should be recognized when it is incurred. What do you mean by incurred kanna? When the obligation to pay particular expense arises to the SSC. Correct? And now try to understand kanna. Sir, as per section 145 and 145 capital A, 145 capital B. Okay, these are the section numbers which are relevant with respect to method of accounting. 145 is talking about, sir, which method is relevant? Okay, for computing your income, for computing taxable income. So total how many heads we are talking about? Kanna 5 heads. First head is salaries. Method of accounting is not relevant. And again, house property, method of accounting followed by the SC is not relevant. Capital gain, method of accounting followed by the SC is not relevant. And for computing income from business or profession and income from other sources, method of accounting followed by the SC is relevant. Carefully understand karna. Section 145 is talking about relevance of the method of accounting. Sir, as per which method I need to compute the taxable income? Sir, salary is, when you check out section 15, they're talking about due or receipt, whichever is earlier. If the salary become due or receipt, whichever is coming first, on that basis is going to be taxable. So accordingly, method of accounting followed by the C is not relevant. House property is the present to taxation. Annual value of the house properties is going to be taxable in the hands of the SC and the head income from house property. So accordingly, which method of accounting you are following is not relevant. Capital gain, any profits or gain on transfer of a capital asset, and transfer of a capital asset is going to be taxable in the hands of the SC in the year of transfer. The year in which you are transferring, in that year the resulting capital gain is going to be taxable. That is section 45. So for that also method of accounting is not relevant. But when you check out income from business or profession and income from other sources, the method of accounting followed by the SC is relevant. Now, while you are computing taxable income from business or profession or income from other sources, as for which method I need to compute their income. So look at Kanna, be it a cash basis or accrual basis. Okay, cash basis of accounting or accrual basis of accounting, which is regularly adopted by the SSC, which is regularly adopted by SSC. In case if the SC is following a cash basis of accounting, as for cash basis I need to compute the BP income or other sources income. In case if the SC regularly following accrual basis of accounting, taxable income from BP or other sources I need to compute as per accrual. Okay, which method was regularly followed by the SC? As for that method I am supposed to compute the income from business or profession or other sources. Correct, sir? In case SC is like, no, while you are computing income from business or profession, if SC regularly follows accrual basis of accounting, then taxable income should be computed strictly in accordance with income computation and disclosure standard issued by CBDT. That is nothing but section 145 capital B. Because you are computing income from business or profession and the two SC is following the accrual basis of accounting. So when he is following accrual, then income from business or profession you are supposed to compute as per accrual in compliance with all applicable income computation and disclosure standards issued by Central Board of Direct Taxes, ICDS 1 to ICDS 10. Strictly in complying with that items only you are supposed to compute. Is it clear, Kanna? Yes or no? Again here, sir, even when you are talking about business income or other source income, as per the basis of accounting which is regularly adopted by the SC, even let's say the SC is following accrual basis of accounting, Kanna, then accordingly I need to compute his income from business or profession as per accrual. But whereas there are certain exceptions for it. When you look at section 35 capital okay, AD or otherwise 35 capital D, 35 capital DD, 35 capital DDA, or when you look at section 43 capital B, these are the certain items, okay, where the allowability as a deduction is something different. When you look at 35D, 35DD, 35DDA, all that expenses are going to be allowed in 5 equal installments commencing from the financial year in which that expense was incurred, be it a preliminary expense, amalgamation or demerger expense, or voluntary retirement compensation. The year in which you paid, from that year over 5 installment you can claim it as a deduction. So accordingly your method of accounting is not relevant there. Or when you look at 43 capital B, certain categories of expenses will be allowed only on the payment basis. In case if it is paid during the previous year or on or before the due date of filing of written off income applicable to the C under section 139 subsection 1, then only that item is going to be allowed as a deduction in the current year. So even though we are dealing income from BP or other sources, you need to compute as per the method of accounting regularly adopted by the SSC. Generally method of accounting is relevant there, but there are certain exceptional cases like your 35D series or 43 capital B series. Correct, Amma? So even by capturing that you need to work out. That is what the discussion regarding relevance of method of accounting. Now coming to capital versus revenue kanna, it is just okay example sake I given. So generally capital receipt is not taxable kanna. Even you are talking about revenue receipt is going to be taxable, but generally capital receipts are not taxable unless otherwise specifically they given a taxability of capital receipt. Correct. And in the same way, generally revenue expenditure is allowed as a deduction while computing a income from various side. Capital expenditure will not be allowed unless otherwise specifically they given the allowability of capital expenditure. Best example 35 capital AD, section 35 scientific research, where they are talking about capital expenditure also allowed as a deduction. But generally, revenue receipts are going to be taxable and revenue expenditure is allowed as a deduction. But in certain circumstances, capital receipt also taxable, capital expenditure is allowed as a deduction. Sir, what makes the differentiation between this capital versus revenue transaction? Check out Kanna. Sir, when you are going to consider a particular receipt as a capital receipt, first one, simple example kanna, here they are talking about, sir, I had a fixed asset, I'm selling it. The sale price what I'm getting for sale of the capital asset, is it a revenue receipt or capital receipt kanna? Capital receipt. Why? Because purchase, acquisition or construction of a particular fixed asset is a capital expenditure, because from that expenditure I'll get a longer benefit. In the same way, when you are selling that capital asset, the amount what I'm getting is not a normal trade receipt, it is sale on account of a capital asset. So accordingly there is a capital receipt. And again, any receipt towards substitution of source of income, basically non-competency fee. Otherwise, when you look at voluntary retirement compensation, sir, my retirement age is 60, but at the age of 40, I'm opting for a voluntary retirement. Now I'm receiving a voluntary retirement compensation from my employer. Let's say I got 1 crore. That 1 crore, what I'm getting by surrendering my future right to receive the salary income. For next 20 years, I'm entitled to receive salary. But by sacrificing that right to receive the 20 years salary, I'm getting this payment. So accordingly, I'm losing a source of income. For that, I'm getting paid a lump sum compensation. So accordingly, any amount what you received for substituting a permanent source of income, it's a capital receipt. And again, any amount received as a compensation for surrender of any rights of ownership. Basically, I'm getting paid for surrendering my right in a capital asset. It's as good as sale of capital asset. So it's a capital receipt. And the profit from sale of capital asset shall be chargeable to tax. Generally capital receipt is not taxable, but when you are selling a capital asset, on that any profit you are getting by virtue of section 45, that capital gain is going to be subject to taxation under section 45. Now revenue receipt, sorry, any amount received towards the circulating capital or a floating receipt. Basically by sale of any current asset, the amount what you are getting, current asset is nothing but inventory, inventory I'm selling off, so accordingly there is a revenue receipt. Even, sir, any receipt towards substitution of income, it's not a source of income. For sacrificing one series of income, I'm getting paid for it. So there is not a permanent source, just that is an income. So accordingly, the receipt for sacrificing income, that one we are going to call it as revenue receipt. That is taxable. Any compensation received for loss of future profit. So even by losing your future profit, if you are getting paid any compensation, so obviously there is a revenue receipt, there is a non-competency fee, and the profit from sale of a trading asset. Trading asset is nothing but your merchandise. By sale of your stock in trade, the amount what you are getting is a revenue receipt, which is going to be taxable under business income. Business or provision section 28. Now when you look at capital expenditure versus revenue expenditure, so even acquisition cost of a capital asset is a capital expenditure, which is eligible for claiming depreciation or deduction, and the expenditure incurred to increase the operating capacity. Any subsequent expenditure what I am incurring on a capital asset, which enhances the revenue generating capacity of an existing fixed asset. So I had 1 floor building, another 30 lakh I am spending constructing 1 more floor. After construction of 2nd floor, the revenue generating capacity of the fixed asset will increase. So accordingly, the 30 lakh what I spend is a capital expenditure. And again, repayment of any long-term loans, right? Any expenditure what you incurred, for releasing from a long-term obligation. From bank loan, from bank I taken a term loan of 10 years. Now the amount what I am paying on the spot now for releasing myself for the long-term liability. So long-term liability, when you take, the amount what you are getting is a capital asset. Now when you are settling a long-term liability, obviously there is a capital expenditure. And again, any amount paid for acquisition of source of income. So I'm making a payment, I'm getting a permanent source of income, long-term source of income. There's a capital expenditure. And again, expenditure incurred for obtaining a capital by issue of shares. When you are issuing shares, any expenditure what you incur is a capital expenditure. And again, revenue expenditure, purchase price of current asset. Basically, I am purchasing a particular merchandise for the purpose of sale. On sale of merchandise, the income what I am getting is the revenue receipt, taxable under BP. Purchase price of that particular merchandise is called revenue expenditure. That is allowed under 20, 31, 37. And the expenditure incurred to maintain the fixed asset. So you are buying a building, here and there repairs and maintenance what you are incurring for maintaining that capital asset in good condition. So all kind of revenue repairs is going to be revenue expenditure. And again, amount for settling the current liability. Current liability in the sense, okay, I had creditor, I'm making a payment to creditor. So obviously you are making that payment to release yourself from a short-term liability. Accordingly, that the expenditure what you incur is a current revenue expenditure. And any expenditure what you incur for earning a income, okay, for earning a revenue receipt, any expenditure what you incur is a revenue expenditure. And again, raising loans by issue of debentures, yes, that is a revenue expenditure which can be claimed as a deduction. That's 71. Majority of this capital versus revenue you covered in your financial accounting, just introductory part I given. Now coming to new alternative tax rates applicable for individual and HUF under section 115 BAC. Very important for your examination point of view, especially for May and May examination or July examination of CMA, because it's a new provision what they brought under Finance Act 2020. Now try to understand, for individual and HUF, they given two options. One is a normal item, normal tax rate, otherwise concessional tax rate under 115 BAC. So already we got first 2 lakh 50 is nil, 2 lakh 50 to 5 lakh 5%, 5 lakh to 7.5 10%, right? So when I'm entitled to pay tax at the concessional tax rate, for that they given certain restriction. So saying that point number 1, 115 BAC 1, they talk about applicability, who is entitled to claim this concessional tax rate. Under 115 BAC 2, what are the restrictions they kept? That means you cannot avail certain exemptions, you cannot avail certain deductions. Now look at here. One minute, guys. Okay, check out who can avail this particular option 115 capital BAC. So basically they're talking about, sir, in case if you are individual or HUF and having income from business or profession. So you are individual and HUF, you are having a business or profession income. Then for what is the due date of filing of return of income? Okay, for current year only they given this option, so for previous year 2021. Okay, for previous year 2021, what is the due date of filing of return of income applicable to that individual or HUF under section 139 subsection 1? If you are not subject to tax audit, 31st July 2021. And in case you are subject to tax audit, 30th September 2021, anyway because of the COVID, they given an extended relaxation in filing a return of income too. And on or before the due date of filing of return of income, which is applicable to you under 139.1, okay, you are supposed to exercise that option. That means for previous year 2021, what is due date of filing of return of income applicable to you under section 139 subsection 1? On or before that date, that individual or HUF should exercise the option whether you would like to pay taxes under normal scheme or you would like to pay taxes under concessional tax scheme under section 115 BAC. Right, Sir, once okay, you are exercising the option, that's forever. Only entry in, exit is not there. Once you exercise the option, that's forever. Going forward, you are going to cover under concessional rate tax rate system only as far as you are fulfilling the conditions covered in section 115 capital BAC. And in case, sir, I'm an individual or HUF but not having any BP income. So I'm individual or Hindu undivided family, not having any income and the head income from business or profession. Correct? Then you are supposed to exercise the option whether you would like to pay taxes under normal scheme or a concessional tax rate scheme covered in section 115 capital BAC. right kanna. Okay, that option you need to exercise on or before the due date of filing of return of income applicable to the current previous year, maybe by 31st July 2021 or 30th September 2021. And again, here every year you can exercise the option. That means it's not like you are having a BP income. So once you exercise the option for current year, yes, current year, before due date of filing of return of income, you need to decide whether you would like to opt for a normal scheme or a concessional tax rate scheme under section 115 BAC. And again, next year also, before filing the rate of due date of return of filing of return of income, again you need to take a decision whether normal scheme or a concessional rate scheme. Correct, Amma? Yes or no? Every year you can exercise the option. Right, Kanna? 1 year normal scheme, 1 year concession scheme, yes, that option is there for you. And again, they're talking about, sir, when you are entitled to avail this particular scheme, when you satisfied the conditions covered under 115 BAC. So what are the conditions to be fulfilled? As of now, you cannot understand anything, Kanna. If you have a slight knowledge about the direct taxation, maybe final kids can easily understand this point. Okay, because under 5 heads of income, different section numbers I am going to cover, different item. Certain exemptions or deductions you cannot claim. So look at Kanna, under salaries, okay, you cannot avail leave travel concession covered in section 10 subsection 5. And you cannot claim household allowance exemption under section 10 subsection 13 capital A. These two are covered under salaries. And allowances covered under section 10 subsection 14. Under 1014, different allowances they are talking about, Kanna. All allowances you cannot claim except the following three. What they are talking about? You can claim transport allowance as a deduction, conveyance allowance you can claim as a deduction, exemption, or like no, or daily like no, any allowance granted to meet the cost of travel. Okay, that is transport allowance, and again daily allowance also you can claim except these four. Can I look at here? Transport allowance is going to be covered separately, and conveyance allowance and cost of traveling allowance, and next one daily allowance. These three are fully exempt allowances, Kanna. Except these four and 1014 you cannot avail any exemptions. And again, allowances given to MPs and MLAs you cannot claim under 10 subsection 17, and allowance for the income of minor 1032 1500 you can claim, now you cannot claim it. And exemption for SEZ unit under 10 double capital AA, we are going to cover this item in deduction chapter. Under standard deduction or entertainment allowance deduction or professional tax under section 16, under salaries we are going to have in detailed discussion. And again, interest on housing loan with respect to self-acquired property or vacant property under section 24, there is house property data. Additional depreciation section 32, business or profession. Deduction 32 capital AD, investment allowance for making investment in any of the notified backward areas of in the state of Andhra Pradesh, Telangana, West Bengal and Bihar. And we are going to cover in BP, Kanna. Deduction for donation or expenditure to scientific research 35 BP, and deduction 35 capital AD or 35 triple C BP. Deduction from family planning under section 57 other sources. Any deduction under chapter 6 capital A other than ATCCD and ATJJA. Kanna, this one we are going to card under deduction. Kanna, for understanding this item, your 5 heads of income should be completed. So even these are the restrictions what they kept. You cannot avail these deductions or exemption. In case if you are not availing while computing a total income, the above mentioned deductions or exemption, then what is the total income, on that you can pay concessional rates of tax. And no set of benefit is available. Any kind of unabsorbed expenditure or any losses relatable to the above mentioned notified exemptions or deductions pertaining to the last year, you cannot carry forward to current year. You cannot claim as a deduction against the current year income. They kept a restriction. Any kind of losses or unabsorbed expenditure relatable to above mentioned item, you cannot carry forward to current year. You cannot set off against the current year total income. Correct? So with this, so we're done with the entire fundamental discussion, Kanna, the basic items. Now we need to pick up certain problematic. Check out, Kanna, approximately I covered 8 applications here, Kanna. That problematic I'll record in the next video. Correct, Amma? So with this we're done with basic concepts in the income taxation, and problematic I'll record in the next video. Am I clear, Kanna? Thank you very much. Miss you all. See you back in the next video.